the dollar's just worthless. It's just paper. It's not backed by anything. What if the Chinese say, yeah, we'll back our currency, 10% or 25% or something. And oh, by the way, we've got 40,000 tons of gold we never told anybody about, that sort of thing. Well, now all of a sudden that's an alternative. And now all of a sudden that same trade that gets conducted between Brazil and South Africa, they don't use dollars anymore. They use the Chinese currency instead because it's perceived to be safer because it's backed with gold. Now all of a sudden they've got all this less demand for dollars, less dollars being plowed back into treasuries. This creates a real problem. And a lot of those dollars come sloshing back home, further weakening the currency. And again, you can, as we've been discussing this stuff, I think people can begin to understand how problematic and how chaotic that will be when it happens. And again, the last point of that, and I've mentioned this now a couple times, you want to know what really keeps me up at night is this generally isn't a peaceful transition.
Welcome back to Liberty and Finance. And Reluctant Preppers, we have a returning guest. Craig Hemke is the founder of the TF Metals Report. He joins us this Tuesday, September 15th, 2020. Craig, thanks for coming back on the show.
Donegan, it's always a pleasure, my old friend. It's nice to see you.
I remember vividly the moment we met. You came up and introduced yourself at the breakfast buffet line at the Embassy Suites in Las Vegas, where we were both going to be attending the second Liberty Mastermind Symposium.
That's right.
And that's where I got to meet you in person. It's been a pleasure. Our audience always appreciates your visits here because you've got quite a following there at the TF Metals Report. You've got a very active community of people who share insights, that sort of thing, and we appreciate you bringing those here. So if we could just jump right in with some what's going on in the world that affects people's financial lives. Maybe this week you can kick us off with talking about the fact that we have another regrouping of the Fed meeting this week to talk about, this is weird. I mean, I hope you'll tell us more about why it's weird, but how is it that with every country in the world running debts, and most of the states in the U.S. being at or near bankruptcy, and many of the municipalities being at or near bankruptcy, and 50% of the people out of work, and 40% of the businesses closed and probably not going to reopen, that the Fed can say, we have unlimited funds. Nobody else has money, but we have money. We got all you need. It's like, why doesn't that ring like sanity alarm bells for everyone who hears that statement? But anyway, that's the question is, what do we expect out of the Fed this week and going forward in your view, and why does it matter?
Well, they've been warning us now through various trial balloons, their favored media outlets, that these major policy changes were coming. The Fed knows, as much as they go out, and they try to reassure markets with that infinite money creation stuff that you reference, the Fed knows that they don't really have any way out. I mean, they like to consider themselves independent, right, and apolitical and all this jazz. But we're rapidly approaching that end game where the amount of cash, the amount of dollars needed just simply to service the existing debt is now just soaring, right? Almost exponentially. But with COVID, we're adding to that existing debt at record pace. The fiscal year in the U.S. here is just about to come to a close. We run October 1st to September 30th every year. And the deficit for just this year is going to be north of $3 trillion. What? I mean, that's just astonishing when you think about it. And it's not going to get any better. There's this politicized hope out there that, there's this V-shaped recovery, that all of a sudden everything's just going right back to whatever it was a year ago. And that's just not.
You looked at the Dow Jones Industrial Average and the S&P and the NASDAQ, didn't you?
Right. And I get that question all the time, like from guys in my golf group. How can the stock market be going up? I don't understand. Everybody's laying off. Well, hey, if you create $3 trillion from nothing, part of that goes to the banks. All of that can be leveraged up. All you got to do is put it in about 10 stocks to make the averages go up. And so there's a complete disconnect there between the stock market and economic reality. But again, we lost 21 million jobs in April. Now, they've tried to tell us that we've put back on about 11 million jobs. Now, even if you just go off of those numbers, which I'll explain why that's bogus in a second, we're still down 10 million jobs, right? I mean, I'm flabbergasted that in an election year, in particular, that Congress hasn't gotten together with the president, and spent another couple of trillion just trying to buy votes. Because, there are a lot of people that are really hurting out there, and those jobs aren't coming back. And I'll give you one, Dunnigan, try to keep me on track. I got too much coffee going this morning, but I saw something, I don't know, 3 weeks ago now on my local television news. They did a local survey, and I live in a pretty big metropolitan area. They said there were only 5 or 6%. They surveyed a whole bunch of local businesses. 5 or 6% didn't think they could make it another month. 24% couldn't make another 90 days. And again, who doesn't know that? How can a small business, a restaurant, operate at 25% capacity? It just doesn't work. So anyway, this notion that we're coming back in a V-shaped recovery is just crazy. And I should go back before I forget. The jobs report that has said we've created 10 million new jobs in the last 4 months, that's bogus too. What the Bureau of Labor Statistics does every month is they take an average of the last 20 or 25 years worth of the month of August, and they know how many businesses are usually started in August and how many usually go out of business in August. And the net adjustment, which is just guesswork based on history, they call the birth-death adjustment. How many new businesses started? That's a birth. How many old businesses closed up? That's a death. And the net number in August, they claimed was 150,000. Okay? If you add up the amount of new businesses they statistically claim have opened since May, it's over 1 million. Now, does anybody in their right mind really think that over 1 million new businesses have started since May?
Don't believe that. There certainly have been. I have to be impressed with the ingenuity of humans. A lot of businesses that never existed before have blossomed, or the ones that were small have grown to adapt to this distorted and basically malformed economy that we have. The people that are doing, delivery of takeout food or things that are other services, that cleanup services that were not at that scale at all before. But that's got to be a fraction of what you just described.
Right. And so, like I said, even if you take it on faith that we've added back 11 million new jobs, we're still down 10. Okay. And I would say we probably added back 2 million new jobs. So all these people are out of business. You see the anecdotal evidence of, the lines at the food banks, and how many people are, desperate just even to find their next meal. They're trying to pay their rent and everything else. So it's this idea that, we are coming right back from, this man-made disaster of locking everything down, I just think is folly. And so the Fed is going to have to continue to monetize all of these demands that the government's going to put on it. And that's where we're headed. If anything, I guess, comes out of this COVID crisis and all the lockdowns and everything else that even continues to this day, Dunnigan, I'd almost say it's almost now we're like frogs in a pot with modern monetary theory. That's that idea that as long as the Fed just monetizes all the debt, and if the Fed owns it, then who cares? They can print as much as they want. And man, as recently as a year ago, we're all pulling our hair out going, oh my God, this is the craziest thing I've ever heard. There's no way that can work. But yet now, that's exactly where we are. The Fed has monetized all the net Treasury issuance this year, meaning the Fed has simply purchased those Treasury bonds that have been issued with newly created cash. That's going to continue next year and beyond. And all of that has significant ramifications, not just for precious metals, but for everybody.
One thing you passed earlier in the beginning, you talked about how the Fed claims they're independent and apolitical. And it just caused me to think, that actually could be a little more true than it sounds. What they want it to sound like is we're not going to be swayed by Republicans or Democrat office holders, incumbents, forcing us to do this or they take that action. But I was thinking about the other side is what we've heard multiple people, G. Edward Griffin and Wayne Jett and others on our show saying, Team Red, Team Blue, two wing, left wing, right wing, two wings on the same dirty bird. As far as there are two heads of the same snake. It's like, okay, maybe they're apolitical in that way, that it just doesn't make any difference who's in the office. We're going to do what we're going to do, and they're going to stay on board. But there's something you just mentioned about the ramifications. Could you dig into that a bit? Because people, ordinary folks, hear monetizing the debt and QE and all these things. Those are descriptive terms, but they don't describe the outcome or how that really hits home for people. Does it mean that the taxpayers are on the hook and our children and our grandchildren are on the hook to pay back all this debt? When they say they're monetizing the debt, does that mean that basically, we're allowing you to go deeper and deeper in the hole and you'll never get out, that kind of thing? And can you talk to us about how you see that impacting people's lives going forward?
Well, one, there's this notion of balancing the budget and getting rid of it. I mean, come on. That's just a political talking point aimed at people that are uneducated about how this whole thing works. And they think, oh, yes, I'm all for balancing the budget, yes. And that's never going to happen. And they have to continually be expanding the budget and continually expanding the debt and the deficit, because that's the system that we have. And where this impacts you and I and everybody listening is, think of it in just simple, basic economics. The more there is of something, the less valuable it is, right? I'm trying to think of what the best example is. Maybach cars. How about that, right? Give me a fancy Rolls Royce, you name it. There are not a whole lot of them, right? And so that consequently, they're pretty valuable. Or, some special work of art, by the true masters. Not a lot of them. So they're valuable. But there's a whole bunch of, fake prints and stuff like that. And the more you have of generic anything, the less valuable it becomes, right? So if there's more and more cars, the less valuable they are. The more and more corn, wheat, and soybeans, the less valuable it is, right? I mean, that's just kind of basic economics. And so,
law of diminishing utility and supply and demand,
right. So the more and more dollars there are, the less valuable they are. And here's where it's, I don't want to say evil. I'm struggling for what the right word is, but they are stealing from you and I when they do this, because you and I and everybody listening, you work hard, right? And you're out there trying to pay your bills and you're trying to save and all this kind of stuff. You get paid in dollars and you go spend your dollars, and whatever you have left over, you save and you stick in the bank, or you put it, in a hole in the ground under your mattress or whatever. Those are still in dollars. Well, as the Fed creates more and more dollars to fund these deficits and debt, they're devaluing those dollars that you saved, in a sense, stealing from you. So, you can say, well, maybe, since we don't ever have to pay the debt off, therefore that's a good thing, because how's everybody going to come up with $100,000 per person, or, whatever those numbers are, to pay off the debt? But even by doing it this way, they're still stealing from you. That's why, the purchasing power of the dollar has been cut by 99% since 1913, when the Fed was first created. So anyways, there's no getting past that. All you can do is recognize how insidious this is to your savings, and then try to save in something other than dollar. You can be in the stock market and hope that it goes up faster than your dollars depreciate. Sometimes that works.
It drives, there's so much you've said. If we could just unpack it for a minute. The debasement of the currency, the destruction of the currency through additional currency creation, it's like diluting every other dollar that's already out there. So every one you have in your account the value is being drained out of that. So that's one thing, and that's you were fishing for a word. I think immoral would be one, because even in the Bible it says it's a sin to deprive the working man of his wages. So if a working man has earned something through the sweat of his brow, he's given up part of his life for that, and he's stored that for the future of himself, for a rainy day, or for his family, or for his children. And now you sneak in through through this back door. People don't even realize that there's this back door in every, doesn't matter if the dollars are in the bank, that's a whole nother back door, but even if they're under your mattress, that they can just be devalued without, just right underneath your nose. But in addition to that, by devaluing the currency, anything you own that you may want to go sell in the future someday is going to have, because you're going to have to sell it in those puny little dollars, it's going to look like you have a nominally higher price, so you're going to have an apparent capital gain that you're going to be taxed on even if you didn't have a capital gain. And oh, by the way, if you're a homeowner or any like real estate property owner, your property taxes are going to be indexed to the increased value of your property. So those are going to go up too, even though it's just the same property. And so there's just many different ways that hurts us. There was something else you mentioned. Oh, balanced budget. When I was in junior high and high school, I kept hearing about balanced budget amendment. Sounded really, really good. And then I learned a little bit more about, like you're saying, about the currency system. And it's like, wait a minute. If the currency is based on debt to the bank and there's interest owed on that debt, then even if you had a balanced budget, you still have to keep paying in on that interest that's owed on the currency itself. Am I wrong?
No, that's absolutely right. Yeah, exactly. And you can't, and if you pay, the whole system is based on debt and inflation, growing more and more of it, creating more and more cash, creating more and more debt. If you start paying off the debt, that's deflationary, right? If you balance the budget and start paying down the national debt, that's taking dollars out of the system and making it deflationary, which might be good for you and I, but it's terrible for the bankers and the politicians in this system. And so that's why they'll never do it. I mean, they can't. I mean, that's how convoluted this has become. And that's, Dunnigan, this is not unusual. It all through history, going all the way back to the Roman Empire. You start with some type of sound money where, okay, we're going to transact things based in gold or silver has been used forever. Then eventually, your needs of your empire continue to grow. You need more and more cash to fund it. And so you start, the Romans started to scrape off shavings of their coins, that's how they devalued their
and
currency.
They debased the actual metal in the coins themselves.
Right, yeah, exactly. And that's how it's always gone. And eventually those schemes all fail. And that's just exactly where we're headed now. We had sound currency all the way to 1971. And now in the 50 years since, it's just gotten more and more out of whack, as now we're completely unhinged and they're just creating it from nothing in these infinite amounts, as Powell or Kashkari talk about. And we're just headed down the same path. And what's eventually going to happen is what's happened for millennia. The pendulum starts over here and then it swings all the way over here and then it swings all the way back. And then we'll start over again from some sound money structure.
Yeah, I don't think it'll be as much a swing as much as a catastrophic collapse of that financial system, because we're getting on the vertical part of the growth curve. That doesn't end well. We've talked with Alistair McLeod, who sees a currency collapse as early as by the end of this year. Rob Kirby's been echoing similar sentiments. And they both say, whenever it happens, it's going to be extremely convulsive and painful to all involved, because ordinary savings are going to get potentially wiped out if people don't take protective actions.
Yeah, and I'm always reluctant to say by the end of this year, that sort of thing, because I mean, frankly, because you don't know what the number is. You don't know how far you can pull the rubber band before it finally snaps. I mean, it might be just fine right here, and it might be fine right here, and then finally you just hit this point where bang. I thought maybe that could be 2011, or 2012, and here we are in 2020. So I'm always reluctant to say, by 90 days from now or whatever, because you just don't know. But what will happen is it will snap one day, and it's kind of like, what is it, Hemingway? They said, "How did you go broke?" Is the old line, slowly and then all at once, right? that same thing will happen. And that's going to be a real chaotic event globally. A lot of times it doesn't happen peacefully either. And so I think we've got to be concerned about that too.
Yeah, that's the thing is we would do well to take what prudent actions we can to protect ourselves as much as we can from that explosion of the balloon or the stretching of the rubber band or snapping. Right. But our ability to really protect ourselves fully is limited. So we'll just do the best we can. There's a question along the way. So those people who have been taking the step of getting out of the dollar, for example, and getting their savings protected as much as they can, like in metals, gold and silver, for example. Victory CSA asked, what will be the trigger that permanently takes gold above $2,000 and silver above $50?
Yeah. Well, let's first start by saying, let's remember where we are. As you and I speak, we're at 1960. As recently as a year and a half ago, everybody was like, oh, gold's never going to go up, right? It had been 5 or 6 years going sideways below 1360. And it was, it's never going to happen. And silver's never going to go back up over 20. That's how pervasive kind of the bearish mindset was. So let's first and foremost, rather than focus on 2000, let's focus on where we are. And we're holding above those old all-time highs. That's pretty important, to be basing here. And silver to be holding above 26, which was a key level back in 2011 and 2012 is very important as well. I think the next thing that's going to happen is twofold. One, we're going to get this election behind us. And regardless of which side holds the White House or holds the Congress, there's going to be a lot of government spending to come. That's going to involve more debt monetization by the Fed, more fiat, more dollar creation by the Fed to do that. And the Fed knows, and this will be something for people to look for after the Fed meeting concludes on Wednesday. The Fed knows that in the past, and meaning the last time we got to this level of debt to GDP and even deficit to GDP was during World War II and in the years that followed. And the Fed knows the only way out of that trap is to inflate some of that debt away, to run inflation so high and drive inflation-adjusted interest rates so low that you can kind of somehow spark enough economic growth to get those numbers back down. This is coming. These strategies to make that happen are coming. And that will be the trigger that eventually gives gold that two handle, that 2,000 plus permanently, that the questioner was asking him.
Mm-hmm. There's a question here on, you talk about the danger to the currency. Don't know exactly what the timeline will be, but that the policies that are currently in force that are being announced are going to stay in force. Last thing we heard was at least through 2023, we're going to have no interest rates or whatever.
Yeah.
LA1 asks, what is Craig's opinion on a post-dollar world's effect on the U.S. domestic economy? So after the dollar, what does life look like for the U.S.?
Yeah, this kind of gets to your, general theme of being reluctantly preparing for all these things, right? Because when this ultimately happens, it's going to be pretty chaotic, and you hope peaceful, but there can be no assurances of that. For now, the U.S. has this position of being the world's sole reserve currency, which means everything's well, not everything, but most everything's transacted in dollars, particularly energy. So if you trade crude oil, natural gas and the like, it's all done in dollars. All of this creates demand for dollars. And if you are, just think of any third-party nation, Brazil to South Africa, you use the dollar to make those transactions. If Brazil's buying some, I don't know, platinum from South Africa, they don't transact that in a South African rand or the Brazilian, a real. They use the dollar as like an intermediary, to get rid of some of that currency risk specific to those two countries. All of that creates demand for the dollars. And in the end, if you're selling products in dollars, like if you're exporting crude oil like Saudi Arabia, you sell your crude oil, you get dollars in return. Okay, so all of these countries around the world have dollars in their reserves. So the U.S. prints them all, right? And we fund our military and our social programs, and we go $25 trillion in debt and all that kind of stuff. But we've not seen, this huge amounts of inflation from that dollar from all that money creation, because so many of those dollars are held by other countries around the world. They take those dollars that they hold in reserves and they buy U.S. Treasury bonds with them, which creates an ongoing market for Treasury bonds, which keeps our interest rates low. It's a remarkably, luxurious position that the U.S. has been in now since the 40s. and particularly since 1971, when Nixon suspended the convertibility of dollars into gold. Well, that's what's insulated us. What will eventually happen, and this is where you have to hope it happens peacefully, is some other country's going to want that privilege. You're going to say, wait a second, that's pretty cool that you can do that, U.S. We'd like to do that too. Let's say, for example, maybe it's a country with over 1 billion people in it, like China. And they think, well, we'd like to be able to fund our military and have welfare programs for our people. So we'd like to create demand for our currency on that level as well. How would they do something like that? Well, to make it competitive with the dollar, they might back it with their own gold, for example. Mm-hmm. At least make it partially convert. The dollar's just worthless. It's just paper. It's not backed by anything. What if the Chinese say, yeah, we'll back our currency, 10% or 25% or something. And oh, by the way, we've got 40,000 tons of gold we never told anybody about, that sort of thing. Well, now all of a sudden that's an alternative. And now all of a sudden that same trade that gets conducted between Brazil and South Africa, they don't use dollars anymore. They use the Chinese currency instead because it's perceived to be safer because it's backed with gold. Now all of a sudden they've got all this less demand for dollars. Less dollars being plowed back into treasuries. This creates a real problem. And a lot of those dollars come sloshing back home, further weakening the currency. And again, you can, as we've been discussing this stuff, I think people can begin to understand how problematic and how chaotic that will be when it happens. And again, the last point of that, and I've mentioned this now a couple of times, what really keeps me up at night is this generally isn't a peaceful transition. The country that had the reserve currency status, which prior to us was the United Kingdom, generally doesn't just give that up peacefully and say, oh, okay, yeah, you're right. It's been unfair that we've had this all to ourselves. They usually fight to keep that power. If China were to one day offer something like that, I doubt it would go over very well with the U.S. militarily. So, that's where the prepping, being aware of all this stuff, being aware of these possibilities is all pretty important.
Yeah, I remember a quote from Warren Buffett several years ago saying the 19th century belonged to the United Kingdom and the 20th century belonged to the United States and the 21st century belongs to China.
Probably. Yeah. And again, this is really difficult stuff for a lot of folks. One, because, not a lot of the level of education in the country, not a lot of people take economics, and stuff like that, to really understand how money's created.
And it's not even the people's fault. Name the opportunities that most ordinary Americans have had to really learn how our financial system actually works, our monetary system actually works.
Exactly. And you have to take this upon yourself to understand. That's how I learned it. And the media is no help, right?
Nope.
A lot of them are in the back pockets of the banks and all the other moneyed institutions and the politicians, and so they're not out there actively telling people how again insidious this whole thing is. And then lastly, it's human nature to just assume that tomorrow's always going to be like yesterday, right? Mm-hmm. This is the only system you and I have ever known. There are very few people left alive that remember what it was like before the dollar was the world's reserve currency. We took over in 1944. That's 80 years ago. To have been an adult in 1944 means you're now you have to be 110 years old. So there's not a lot of people that can go, yeah, here's how the system used to work. Mm. And so we're kind of lulled into a sense of complacency, thinking that this is how it's always going to be. And history suggests that it's not always going to be this way.
Speaking of alternatives to the U.S. dollar, David Berg asks, how much impact does Craig think cryptos have in siphoning off financial assets that would normally go to gold and silver for safety? It's the new mentality with millennials.
No, I don't know. That's been a question now for a couple of years. What was it, 18 when Bitcoin went crazy? Maybe that was 17. But that was always the question. Well, now no one's going into gold because so many people are buying Bitcoin. Nah, look. Yeah, it's nice. I'm glad that if you want to say millennials that are buying Bitcoin are doing it because at least they understand some of the stuff we're talking about, right? Now, some of them see it as an investment. They think that you can buy it at $10,000 and it's going to go to $20,000 or something like that. But I think a lot of folks do buy it because they think of it as, money outside the banking system. That's good. That shows your thinking, that just simply holding dollars and keeping your own personal reserves in dollars is probably not the best strategy.
It may be the worst strategy. In fact, if you're keeping them in the bank, so anything that's real would be better than something that can be debased like that.
The idea that a handful of, and honestly, I don't mean to downplay it and try to minimize it, but it really is a small amount of people and money that is in Bitcoin versus the vast amounts of money that's already held, or the central bank cash that's already held in gold, and they're buying more.
Yeah.
Or the vast amount that's in institutions like hedge funds or pension funds that are not going to buy Bitcoin in mass, but they might take 2 or 3% of their assets and buy gold. You can't even really compare. That's a minnow versus a whale. And so to get back to your questioner's question, I don't think there's much to that.
Okay. Now, on this next point that you raised of institutional size or central bank size or governmental size moves into metals as a safe harbor through this coming storm, Jay Verdeber says, how much pressure is on the Comex for December contracts on both silver and gold? Will it all be just rolled over or kicked down the road?
Yeah. What's funny, before we started talking, I've been in the process of writing an article about that today.
Okay.
And I write something every week for the folks at Sprott Money, and they post it on their website. And so I was in the middle of writing that. I usually do that on Tuesdays. So the numbers are right here, fresh in my brain. The Comex, because it damn near broke back in March, almost completely blew up. There were actually kind of mini delivery defaults that day, the kind of stuff we've always been waiting for. When that happened back in March, the CME group that owns the Comex has been trying to hold that thing together with a whole bunch of extraordinary measures, making new contracts that are deliverable into fractional ownership of bars in London, stuff like that, changing the rules to allow just about any mom and pop refinery their products to be used to deliver against their contract. They're doing everything they can to keep that pricing scheme working, because if you're pricing a commodity like gold based off of the trading of these derivative contracts, you've got to at least physically deliver some metal at that price. Otherwise, it's illegitimate. It doesn't. How can you say the trading of these paper contracts actually reflects the physical price of the metal if you're not delivering some at that price, right? So they've always maintained this illusion, this charade of delivery on the Comex. And over the last 5 years, 2015 through 2019, the Comex delivered something like, I'm trying to remember the exact number, I just did it, like 650 metric tons. And you think, that's a lot. 650 metric tons over 5 years. No, that's really not very much, especially when you understand that here in 2020, they're on pace to deliver about 800 metric tons. So the 5-year average is 120. They're going to do 6 times that this year, 7 times. They can't do that forever if this continues. And I think that's the bind they're going to get into. And man, if we get to the point where, and I'm not going to do this to you, I promise that, Dun. I'm not going to say, and so come December, the Comex is going to default. That's a whole loser's game too, because then when they don't default in December, what's it going to be? Well, come April. Look, man, you can go around predicting the world all the time. You're only going to be right once. Eventually, though, again, it's like the whole monetary system. That rubber band will snap. It began to snap in March when the abuse of the system that they had going on darn near failed on March 23rd and 24th, and they've been holding it together with baling wire and chewing gum ever since. If this level of physical demand continues, and we talked about institutions, if all of a sudden, Warren Buffett is buying Barrick, and then, a week later you see that some big Ohio firefighter pension fund is putting 5% of their assets into gold. If you start getting into that sort of thing, and people actually demand actual physical gold, this current pricing scheme just can't do it. And so we could get into some real fireworks in that regard. But will they get, God, what a long answer I'm giving you. Yeah, they'll probably piece it together in December. They'll hold it together. just like they going to hold it together in October and how they somehow found gold to allegedly deliver in August. But at some point, it won't be able to continue, and we just have to wait for that.
The visual that you keep presenting, and it's tactile too. I mean, we've all experienced it. If it's pulling a stretched rubber band until it finally snaps, your anxiety just builds and builds because you know it's going to happen. Or if you've ever blown up a balloon for a child's birthday party, you just keep on going and going and going. It starts to make that squeak, squeak, squeak sound.
You kind of exactly.
I have to give this person credit. A young business person who reached out to me as a first-time bullion client about 2 months ago, who was walking away from the advice of their financial planner. The financial planner was saying, just stay in stock, stay in the market, don't take a step out because you're going to miss the best days, and the market just keeps returning 7 to 10% year over year over long term. Got to stay in for the long term. And diversify was the message from the broker. And I'm not against the word diversification, but the way that it was being pitched, I think very typically to this particular young business person, was that you want to be in some stocks and some bonds and some international stocks and that sort of stuff, and that way you're diversified. But what I tried to explain is, if you picture the surface of a stretched balloon that's being inflated and inflated, and there's the stocks of all these different companies are like on the surface of the balloon, and there's the bonds that are on the surface of the balloon, and there's the international stocks that are on the surface of the balloon, and they're all on the surface of this stretched tight balloon, that when the thing blows, what good did it do that you were in 20 different places on that surface when it ruptures? You need to be not at that place. You need to be not vulnerable to that. As an engineer, we talk about failure modes, and there's just so many failure modes that even at the Liberty Mastermind Symposium that you and I met at, there were some of the speakers talking about the potential. It was John Rubino speaking about the number of ways that things could go wrong were myriad, and today just is so much more distorted.
Yeah, that balloon's been blown up even bigger.
Yeah, and the dependencies. So anyway, just to remind us all that in order to be as safe as you can get from that coming disruption when it happens, you need to be not on that stretched surface. You need to be not in that financial / banking / brokerage / dollar system.
Or at least, Dunnigan, too, since we don't know when that balloon's going to pop, the problem with that diversification the stockbroker was talking about is you're still all in fiat currency based things. Even your international portfolio,
right? Exactly.
Is either in dollars because it's stuff that's traded here, or it's in some other fiat based, currency, euros or yen or something. So it would be more prudent to diversify, as you diversify, because diversification is always prudent, to have some non-dollar based, non-debt based investments. That's what the diversification should be. You never want to be 100% anything. You wouldn't want to have 100% in gold, because what if all of a sudden, this all continues for 5 more years, but you do want to be diversified across, have some gold in your portfolio. And that's where it gets interesting, because right now no one does.
Yeah, it's like 0.5%. Yeah.
Yeah. No, and with that 0.5%, that's the global asset allocation to precious metals and mining shares and that kind of 0.5 of 1%. My gosh, what if it goes to 2%?
Right.
So that's all part of what makes it so compelling to be in the metals at this point.
If people want to follow your work, you mentioned how you write on a regular basis. You run TF Metals Report. There's some blogs and things there, some chat rooms. What can people get plugged into if they want to get more of your work, Craig?
Well, thank you, Dunnigan. It's my baby. I've been doing this now for almost 10 years. It'll be 10 years in November, which I don't know how we did it. Because there was a lot of wandering in the desert, man. Mm-hmm. From 13 to 18, that was I was only 25 when it started, and look at me now. No, anyway, we made it. And now, the site's just humming. And like you said, it's people from all over the world, all political stripes. We treat each other with respect because we're all in the same boat, right? Mm-hmm. It doesn't matter if you're on the red team or the blue team, man. We're all on the gold team, really.
Well, and that's a really good point. I think that's a really good point, because I was kind of making fun of that idea earlier about, the red and the blue don't matter because they're all in the same, 2 heads on the same snake. But turning it around on the positive side, we people are all subject to those risks together, and we're all going to get hurt by that together unless we find a way to help each other.
That's right.
Good for you.
So what's the point of sitting there saying, "Oh, Trump's terrible"? No, Trump's great. Who cares? Okay, what we got to try to figure out.
There's a train hurtling down the track towards us, you guys. We got to get off this track.
Right. And again, look at what has happened. I mean, everybody thinks that one party's bad or one party. I mean, look at what has happened over the last 50 years under both parties. Okay. And they want to paint one party as being, well, the reason why there's this wealth and income inequality is because of the Democrats. No, it's because of the Republicans. Yeah, that's what I read too. No, it's because of the bankers and the Fed and the politicians together. And that's how we've gotten to this situation. And so we're all in the same boat. And we've got to help each other out. And so that I write a podcast. I mean, I write a post every morning talking about what's going on that day. I record a podcast every afternoon, kind of summarizing what happened. I mean, I recognize that people on my side, I don't have time to follow. They're leading busy lives. So they come to me to have me tell them what happened. In between, everybody on the site's always adding stuff too. Now, have you seen this link? Have you seen this about this certain mining company? Have you seen this bit of research? That kind of stuff. So I think it's a pretty handy wealth of information for people for a whopping $15 a month, 50 cents a day. I think it's worth it.
And folks, I also want to remind you to go to sign up for our free newsletter at libertyandfinance.com. That's our homepage. On the homepage, just go over on the left-hand margin, put your name and email address in there. You get on our free email. We'll send it out 3 times a week. It lists all of the interviews we do, including this one will be in there with Craig Hemke, including the full description. Any links, we'll include Craig's links there as well, and any special offers that any of the guests we talk about or any articles that we mention will be links in there as well. So you want to get that, it's free. It's at libertyandfinance.com. So we've been speaking with Craig Hemke, the founder and host of TF Metals Report. Craig, as always, thanks for joining us on Liberty and Finance.
So it was a pleasure, my friend. Hopefully we'll do this again soon.
To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.